Most people have an umbilical cord to money. And money is a very, very emotional subject, especially if you don't have it. It's something you crave, you chase, in some people's instance you worship, or you loathe, and you loathe people that have it. Either way, it tends to be something that's emotionally charged. And I've run this line so many times in events around the world. If you listen to this right now, have a think about this. Finish this sentence, right? Money is a blank what? What is money? What's the one word or two words that you would use to describe it? And most people will come up with words like freedom or choices or lifestyle, and they're very emotional words. So there's very clearly a linkage between the word or thing itself, money, and emotion. And that's what probably holds 80% of people back with their investing career. Learning to cut that umbilical cord and refer to it in units, it's not dollars, it's units, goes some way towards separating that emotion. Hey guys, welcome to this week's Money and Investing Show. This week we're looking at what separates the 80-20, the 80% of people that struggle with their investing and the 20% that are successful. Key takeaways and real life experience all the way through here. So as always, don't just listen, make sure you take notes and make sure you take action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Upstaged as usual, looking very good, Mr. B. Now, today's topic of conversation, this is going to be a controversial one. I want to talk about why 90% of investors fail and lose money and why 10% succeed. What's the secret sauce?
Yeah, it's an interesting one. 90, 80, whatever the percentage might be. You always look at life, I think, was it Pareto analysis, 80-20 rule, just to be really crude.
That's right.
And we'll give more people a chance of success by doing that too. And the answer is generally pretty simple. The 20% that succeed, success leaves clues. They follow a game plan, a process, as I'm sure we're going to dive in. They've got a very clear intention. They've got a level of skill. They're not winging it. And most importantly, they're not relying on luck.
Indeed. And the small majority, on the other hand, exceed their expectations and do far better than what their dreams could have ever have possibly imagined, which is the goal for all of our listeners here.
Too right. And I mean, that requires a number of things. One is time. It's getting started and really making it happen. So let's dive deep. Let's see what we've got.
All right. Most common investing mistakes for a start. So why in those 80%, what commonly do we see?
I think people get buffeted around by their emotions. And I know we'll talk more specifically to emotions shortly. And I guess the easiest way of highlighting that is you're affected by noise. News in particular, if you're in the stock market, but also the same can now happen in real estate too. You know, you think about the different headlines. Are we having a rate cut? Are we not? Changing of stamp duty? Are we not? Oversupply, undersupply, immigration policy, no immigration policy? All these sort of headlines can really knock people around in terms of where they're at. And I think as human beings, we've got an ability to absorb X amount of information, and if it's more than X, and this isn't trying to besmirch people's ability to take on board information, but sometimes you can sort of see what's going on. It's like having 20 TV channels all on different stations, or 20 TVs on different stations blaring in the background. There's heaps of noise, you know what it means, and it causes people to freeze and do nothing, or react to that noise and make the wrong decision.
Yeah, you're too right. And that emotional spike causes impulse decisions. Impulse decisions seldom do very well long term.
We think about FOMO, fear of missing out, is a huge one. You know, and you get a market, whether it be property, whether it be crypto, whether it be the stock market. Most people watch because it's a lot easier to watch. That's what, think about a game of sport. You know, there might be 22 people on the field, or 30 if it's a game of rugby union, and you've got tens of thousands of people sitting in the stand watching.
Yep.
You got to make the money. You got to be on the field to play. They're the people that get paid. You're the one paying the price of admission if you're sitting up in the stand, right?
That's right.
And yet most people sit and watch, and investing is just the same. There are a handful of people relatively that are on the field running hard. Everyone else is, I'd like to, maybe I should. And that, I guess, catalyst for taking that action step, to step onto the field, requires such fortitude, confidence to actually fire through and take an action step. It's easier to do nothing than something. You watch this thing keep going up and up and up and up and up until you go, oh gee, I better get in before it's too late. And you can almost guarantee you're getting in at the ding dong high just in time for it to pull back. You know, so FOMO is a huge one for people.
And look, you and I are human, so let's do, for the benefit of our listeners, share some examples of some mistakes that we've made in our investing career that's been emotionally charged. If there's anything that come to mind for you.
Yeah, plenty. How long we got today for the podcast?
One or two.
I'll give you two. One in property and one in the stock market.
All right, let's hear it.
So, as you all know, I don't like paying full price for anything, which has served me terrifically well as a trader over the years. I fell foul of that. I had a property opportunity in Brisbane, and and I love old buildings. I've renovated one in London once, and I love old buildings. And this was in Brisbane. It was the old sugar refinery in New Farm, which most people will be familiar with. And I had an opportunity to buy a particular piece of real estate in that redevelopment of that site. And it went for about 50 grand more than what I wanted to pay. I could have paid. I could have gone up, but
So it wasn't affordability that was the challenge.
No, I just had a number in mind that I was going to go to. Yeah.
Okay.
And I reckon that decision's probably cost me about $4 million.
Oh, that hurts. That's an opportunity cost.
Yeah, I mean, that's the reality of it. Sometimes, you just got to step in and get on with it. And if I'd have been prepared to sacrifice my stubbornness / principles / expertise, which clearly wasn't that expert, I'd have owned that particular piece of real estate, and I'd be net $4 or $5 million better off because of it. So
what was the emotion that drove you from not wanting to
That's my number, and that's it. And be disciplined.
True
Andrew.
rigidity.
Don't go past that. And at the time, that was, and I don't think that's necessarily. He said trying to put a softener on his mistake here. You saw it live right in front of you. I think as human beings, sometimes we can coddle ourselves. I had good reason for that, and I've always been at an auction. That's my number, and I'm never going past it. So there's a level of self-discipline that's in there, and at the same time, I could have put my hand up and gone again, but who knows where that's going to stop? It could have gone again. It could have been several $100,000 higher. I just said, no, that's my number, and I'm out. And I respect my self-discipline. I'm annoyed at the outcome, but I haven't beaten myself over it. You know what I mean? I've done beat myself up over it. I drive past that place reasonably often, so some other stuff I do in that area, and every time I look at it, it's like, yeah, that would have been nice, but everything's a lesson in life, and that's probably loosened the shackles a bit for me. And other things, I try and look longer term.
So next real estate deal that comes your way, just
no.
Sign it, pay it.
No, I've done the same thing. I've not chased stuff at auction, because I think if you buy at auction, you've invariably paid too much.
Yeah.
So I try and do stuff outside of auction conditions if I can. But I think also at the same time, you've got to do your numbers on stuff as well. And at the time, it would have been a punchy outlay, but it would have been a cracker. But that's with the benefit of hindsight.
Yep.
So that's on the property side.
What about shares?
Ooh, which one? There's been plenty of
Can't
those.
be Netflix. We've heard that one, our listeners, last week.
Netflix is a very, very simple example. And I think the challenge of being an active investor, you can set levels in markets where you get in, you get out, and you think, well, if it kicks on, I'll get back in again. But that indecision to get back in, or the need to see more proof as a human being, can sometimes weigh reasonably heavily on you. Go, I'll just look for a little bit more, and then it can run. And then you get into that, it's already gone too far. I'll have to wait for a pullback. It doesn't pull back, it goes again. And then you're chasing the thing higher and paying way too much for it. And I've had, as all investors have, had that experience, I'm sure. So one of the things I like to use for entries in trades now, I like to sell puts, because it's just going to get me in if it hits that price, and if it doesn't, I'm picking up a couple of percent on it anyway. A bit annoyed on a few trades where I've picked up a couple of percent by selling the put and missing out on 20-30% on the overall asset moving up. But I find that a really good low emotion way of getting in the market. And don't feel sorry for me, I'll make ends meet anyway, but they're real mistakes that as an investor I've made, and I wouldn't say I continue to make, because I've modified my strategy to include selling puts to get set, rather than sort of sitting on the sideline waiting for a trade level. But there are a couple of examples in the murky well of investing experience that I've had over the last 30 plus years.
It happens, and I'll give you one.
Give us some of yours.
This is an example of underconfidence. I was a fair bit younger, so I would have been very early 20s at this point. And I remember a family friend of mine, who I'm good friends with his son. He's quite a successful businessman, but he had a new business he was starting up, and he needed investors. He's looking for capital. So he was offering convertible notes at a pretty decent price. And I had the opportunity, my family did as well, at a certain level. Now, at the time, I didn't really know what I was doing. I don't think we ever do. Pretty sophisticated
product that for someone in their early 20s. That's normally something, the preserve of wholesale investors.
Right. It was relatively inexpensive to get in at the time. And I would trust this family friends of mine with my life. So at the time, it was a really good opportunity, and I knew it was. And I didn't do it because I was too scared at the time. And that's probably cost me at least $500,000 in missed earning potential from that. And I kick myself now, because that business is about to list on the stock market and they're about to go bonkers, right? And I had a very early opportunity that I was just too afraid to do.
Well, let's unpack that a little bit, because you can beat yourself up over it. I'm sure you're not, because it's already in the rearview mirror and you can't change the past. But there's always a situational context. I'm going to give you a get out of jail card here. There's a situational context. And I mentioned buying into something that's a convertible note that you can then convert into shares or get a fixed return on your investment, either or. As I say, is a pretty sophisticated product. And then if you consider in the context what percentage of your net wealth you would have had to have put down at that time in order to participate on it. So it would have been I'm going to suggest a big over allocation of money to something that's a very sophisticated product, which you may or may not have properly understood, which may or may not have worked out. It's easy when they work out to go, gee, that was a ripper, versus, I can't believe I got sucked into that one. That was a shocker.
Right.
And so there's some real life signposts that you could pull out of your pocket as a get out of jail card for not going ahead with that and not beat yourself up for it. The fact that you're happy to talk about it, it's a blow to all of our egos when we get it wrong. But I think that in the space that we're in the advisory space, or be it the coaching or educational space, humility is so important. And we have tens of thousands of clients that look to us, that trust us to guide them and assist them in their journey. And I think we've got to give it to people warts and all, because they'll make mistakes just as we've made mistakes, and we'll always make mistakes because it's a natural part of making decisions that some of them aren't going to be that good. What's really important to understand out of this is they're not just, stuff that up next. There's a learning experience that goes alongside it. As I just mentioned about my entry for fixing re-entry into trades, I use that. So it's a modification in my strategy. So people we're guided by need to understand that we make mistakes, but we also learn from them too.
Totally. And I think it all comes down to emotional control with investing, for sure. That's the avoidance of mistakes, but also learning from them, as you say. So can I ask, AB, as we venture through mistakes, what's some of the most important emotional traits of any successful investor? What's the issue with the 80%? What are they falling foul of?
I think that most people have an umbilical cord to money. And money is a very, very emotional subject, especially if you don't have it. It's something you crave, you chase. In some people's instance, you worship, or you loathe, and you loathe people that have it. Either way, it tends to be something that's emotionally charged. And I've run this little line so many times in events around the world. If you listen to this right now, have a think about this. Finish this sentence, right? Money is blank what? What is money? What's the one word or two words that you would use to describe it? And most people will come up with words like freedom or choices or lifestyle, and they're very emotional words. So there's very clearly a linkage between the word or thing itself, money, and emotion. And that's what probably holds 80% of people back with their investing career. Learning to cut that umbilical cord and refer to it in units. It's not dollars, it's units. Goes some way towards separating that emotion. Why? Well, people have got to work pretty damn hard for their money. You might be doing overtime, traveling away from your family, spending time with a boss you hate, whatever it might be, to try and get that after-tax dollar saved up to do something with. So clearly, there's a huge emotional connection with it. That will not serve you when it comes to making investment decisions, because effectively any kind of investment decision is a conscious effort to expose that hard-earned after-tax, after-expenses saving, deliberately exposing it to risk.
It sounds pretty daunting when you put it that way, doesn't it?
And that's the reality of what we're talking about. So you can understand why there are red stop signs for so many people on the way through here. You have to let your money work for you. To do that, you can't hold it tight. You can't choke it. You've got to let it grow. And that's probably the biggest thing that holds people back. So you have to be less emotional about it. And the way to, I guess, reduce that emotional attachment is to replace emotion with something that's inert, which is education and facts.
Gotcha.
And if you educate yourself and you learn facts about what this is all about and how to mitigate risk or how to hedge or how to buy protection on your portfolio, whatever it might be, all of a sudden those emotional fears that you bring to the table are replaced with facts as opposed to emotion. That makes it much, much easier to loosen the grip on your money and then let it go working for you.
Totally. I think to add to that too, the absence of having a plan around all of that makes a huge difference. If you're highly emotional when it comes to money, you're far more likely to act impulsively, in my opinion. If you act on impulse, chances are you're going to mess it up. So I think if you can remove the emotion from it and then come up with a plan which is really based around numbers, because let's face it, it is a recipe card that you need to follow. And if you follow, you get X usually, right? Whereas, the absence of that can be quite costly. So my question to you out there, AB, is for our listeners, if they don't currently have a plan in place, they find themselves fairly emotional with money and fairly attached to it, what's the remedy for that?
Look, you have to have a written plan for a start. People, I've got a plan, I know what I'm doing. It's all in their head, and you've got to get it down on paper, because then it's committed insofar as you've taken the time and effort to write it. And it's, I'm not going to say it's set in stone, but it's down on paper, which is
real.
It's real. You can read it, you can touch it, you can share it with people. When it's in your head, it can be quite fluid and bounced around by, what your emotional state might be on that day, the news that's flowing around, et cetera, et cetera. So having that concrete plan laid out, you can also then stress test that concrete plan that you've got there by going, okay, if I invested this, what would it have achieved? Where was the risk on it? And actually break it down and look at the best case scenario, worst case scenario, and maybe the middle of the road where it's likely to happen. So spending some time getting it written down and articulated is key. And that's actually very, very difficult, because it's quite confronting. You say, all right, I'm going to sit down and write what my financial game plan looks like. Well, where do you start? Okay, well, this is what I earn, and these are my sort of fixed costs, mortgage, utilities, food, whatever it might be, school fees, whatever's going on in your particular lane. And this is hopefully what I've got spare, which is enabling me to save, build up my emergency fund, or accumulate some wealth to do something with. It's this which I'm focused on. What can I do with this? How much of it am I going to commit in one place versus somewhere else? And actually articulating that and writing it down. And once you've done that, it starts to put an enormous, I guess, pressure release valve between you and the emotion of thoughts around money, because when you're writing, you engage a very different part of your brain. It tends to be much less emotive, much more, I'm not going to say intellectualized, but you tend to be a lot more objective in terms of what you're writing, or better yet, typing, when it comes to that sort of thing. And you can always backspace and change it and let it evolve over time, but at least it's given you something that's a cut that you can look at and work with a partner or friends or a coach to say, hey, I'm on the right track with this.
Absolutely. And I think to add to this too, we talked about emotions and plans. Amidst all of that, which I think underpins everything pretty much, is taking time. So having a long-term mindset. And I find that investors who necessarily aren't that successful in their investing focus too much on the short term. Too short term. Long-term mindset, really important. Why?
You have to have time working for you. And if we're talking about investing in, let's just say, more traditional assets, whether that be real estate or stock market, breaking into the two primary areas, plenty others, of course, as well. Having time for something to work is essential. It's like putting seeds in the garden and a day later going, how come I've not got any tomatoes? Well, this is a 6-8 week process before you're going to get that, which involves you tending the garden and providing some food and nourishment into this. Trading and investing, or property investing, is just the same. You have to let time do its thing. And the interesting thing with these asset classes is effectively they're an inflation hedge. So if you've got a higher cost of living and inflation, real assets like that will move up in value typically. So you're going to get growth in that more difficult time for people where there's a cost of living pump that we've seen over the last couple of years, as an example. But if you miss that, time's not on your side. The cash that you could have invested, that you needed to buy. Let's just take something really simple like Commonwealth Bank. And if you look at the charts on Commonwealth Bank, a couple of years ago, it was in a range of $80 to $100. Sell at 100, buy at 80, sell at 100, buy at 80. Now it's $170. Now, if you'd have been sat in cash waiting to get into the Commonwealth Bank, well, basically you can only buy half the shares that you would have been able to buy 2-3 years ago, because the share price has moved up. Also, there's a dividend that's payable on them. Let's keep the math easy and say it's 5%. That's 5% on a $170 stock now, not 5% on a $100 stock. So the dividend is also increased in line with that appreciation. If you're set in cash, your bargaining or your buying power is totally gone. Look at the same thing with property. Property you could have bought for $500,000-600,000 $3 years ago. It's $1 million now.
Yeah, my pop always used to tell me what's expensive today is cheap tomorrow. So if you see it for what it is and take the right perspective over time, assuming that you've done your research and your homework, that investment should appreciate in value, which I think a lot of people forget.
Got to buy quality assets. Got to do your work to buy quality assets, but once you've done that, leave the damn thing alone.
Yep. What did we say in our last podcast? I think it was never sell, right?
Never sell. Yeah, sometimes you got to, but
sometimes you have to. Yes, we admit.
I think that notion of if you've bought something that's in tune with where the economy is, that's got a growth trajectory behind it, then holding on and letting it run its course is probably the most passive and hardest passive decision you'll ever make, because every time you turn on your screen or look at a valuation, you go, gee, it's gone up. When are we going to take profit? I'll just let it go.
That's right. Here's an interesting one. 80% of investors, we say roughly, succeed, and they put risk management first. Why?
Of the investors that succeed, the ones that are successful have to have risk management first for the simple reason it doesn't matter what you make, it's what you get to keep. If you have no risk management and you're just sort of shooting the breeze and seeing what comes along, effectively you're relying on luck, and luck always runs out. I think having a level of risk management is key. It's also important that you don't get scared of shadows where you get chopped out of trades. I'm going to have a stop loss at 2% from where I got in. You're going to get chopped out all day long. You're going to make your broker very rich, but you're not going to make a cracker out of it. So, you need to have something that's there as a safety net, but it can't be too tight and it can't be too loose. So there's an art form in how to manage and mitigate risk, and that's going to be determined by individual perceptions on risk. So I'll give you a really simple example of this. If we went to the airport to hire a car, and you had a choice of having the default $700 excess, you can reduce it to $200 excess, or have zero excess on your insurance policy, what would you take? And you can guarantee if you had 50 people in the room, each one of them would be skewed either up or down depending on their attitude of risk. Some people would say, look, I'm not a great driver, I'm going somewhere where most drivers are pretty average, or I'm in the city, or it's a high crime area, I'll have the zero excess, that suits me. There are other people that would be more cavalier and they go, don't worry about it, leave it at the 700, I'm not going to need it anyway, I'm a positive person and I can't imagine having an accident, so I'll be fine. And then you've got the people that sit somewhere in the middle. And that's a really simple example of how to mitigate risk when it comes to investing. Some people are going to be very anti-risk, others are more comfortable with it. So you've got to move that around in a way that tends to suit people. But either way, you need to have a level of risk mitigation.
Yeah, I'll give another example too. Let's say you're buying your first property. An element of risk management is actually having more cash available than what you actually need.
Yep.
Why? Well, there's furniture, there's unexpected expenses, removalists. Let's say even it's an investment property, and let's say that investment property is going to be negatively geared. Working out what your earning capacity is and what that property is going to cost you, and making sure there's enough there left over to be able to satisfy that is also an element of risk management. So I think even just having more cash available, it makes a lot of sense.
I agree. One of the things that we talk about in the book, funnily enough, is if the bank's offering you the ability to borrow X, take less.
Correct. Yeah.
Don't stretch yourself yet. The pressure is, because the markets run pretty hard, borrow as much as you can so you can get in. I think you've got to give yourself a little breathing space because circumstances can change. Let's say, for argument's sake, you and your partner buy a house, and then you find yourself, you're going to have a baby. And so you could be potentially one income down. How are you going to go at servicing that debt on the back of that? As an example for a young couple, or maybe if you're a little older, maybe you have a health crisis and your ability to service the debt changes on the back of it. So I think if you give yourself a little bit of breathing space, and I guess this isn't about chasing the wind in terms of return. It's also about playing it safer when necessary too. And I've always been of that view that there are red lines in life, tram lines in terms of like how much you can borrow, what's safe to, based on what the bank says, versus what in your heart of hearts that you'd feel comfortable with. And
That's right.
It probably sits somewhere between the two as to what you should take on. And that way you give yourself a little bit of a buffer. You're not overstretched. And people only benchmark against the best times. That's another thing I think that separates the 80-20 or the 90-10, and that is that the people who are successful will look at what happens in the good times and what happens in the not good times, and be objective about what the not good times look like so that they can have a good handle on that and not let it give them fear of getting started. Okay?
Totally.
And I had this conversation with someone the other day. They said, the market's due a correction. I said, when's that happening? Let me know the date so I can be short. and I said, just out of interest, how short in the market are you? Oh, what do you mean? Well, you're emphatic that it's going to collapse. And so,
why aren't you profiting from the downswing?
What's your position to profit from that?
Yeah.
Oh, no, it's just going to pull back. Okay. How much are you going to pull back? So probably 20, 30%. It's like, okay, that's interesting. So how long have you been sat at? Oh, a few years. And it's, okay, if you take the NASDAQ as an example, which is at an all-time high right now and has put on 50%, 60% over the last couple of years, pretty much on a bottom left, top right chart since 2022. Even if you had a 30% pullback from where it is right now, you'd be so massively ahead by being in it after that pullback than you are from being sat on the sides.
Absolutely.
Yeah, I know, but it's going to pull back. It's like, okay, you can only work with a living. You've got to kind of move on with the next conversation at that point in time. But, some people are just so emphatic on focusing on the risk that they miss the opportunity that time would have created for them.
That's right. And when the NASDAQ, if it does pull back 30%, guess what? Buy some more. Sit on it for the long term.
Short it, buy some puts, have risk management, do whatever, but don't sit out in the anticipation that one point, sometime down the line. I think the concluding part of our conversation was, look, you do understand even a broken watch is right twice a day.
Nice. And look, to our listeners there, this and that example may sound a little bit complicated, but it doesn't have to be. Even, for example, making additional contributions to your mortgage is an element of risk management. Mm-hmm. And I think that's prudent in any strategy that you've got. So if you're an investor, being that you own shares, property, whatever, focus on what the risks are.
Look, I mean, you think about offset accounts, which a lot of people use, are very tax effective. And if you've got it's hard to say nowhere better, but if you're not in a position where you're comfortable enough to invest in other things, using an offset account to save yourself interest makes perfect sense.
Absolutely.
And it's it's a physical step in debt reduction to an extent, and you don't have to crystallize it. I also like offsets because you're not actually paying the loan off, which means you can redraw that money if you need it for something. Whereas if you have paid it off your mortgage in a bona fide way, and maybe the economic circumstance changed, the bank's probably less willing to let you have that money back when circumstances have changed, when you might actually need it. Whereas with an offset, well, you've got the ability to get access to it as and when. So it does tick a few boxes. Very simple thing to do, which can help move you along. Not our lane, but it is another way for people to be able to, get a little bit more financially ahead. And people are blinkered to this. Oh, no, I'm not going to pay that off, or don't really understand it, which comes back to, if you don't understand something, you're probably not going to do it. So get educated. Indeed. Learn about this stuff.
Absolutely. Now, last topic of conversation, AB, before we wrap up, we've spoken about primarily why most people aren't as successful in investing as they'd like to be. If we can get a quick fire, rapid sequence of answers, what would tend to be the most traditional key habits of successful people in that small 10 to 20%? What are they doing differently?
Discipline, focus, education, open-mindedness. There's 4.
Nice. Long-term mindset, unemotional, and very resolute. Yep. Insofar as what the plan is and sticking to it.
Sticking to your plan is key. I think that determination, dog determination on what you do is key. Yeah, they're really simple attributes that people have that anyone can build up.
Yep.
On the other side of the coin, no discipline, blown around by news flow, going to wing it. Let's just give it a go and see what happens. Not today, maybe another time. It's not the right time for us. I have people saying, "Oh, I love what you guys do, but it's just not the right time for us." It's, well, tell me when, other than yesterday or the day before, when is a good time to have more income? Oh, well, when you put it like that, that is the only way to put it. You have to take action. So, it's never going to be the perfect time. The only perfect time was yesterday.
It's a good way to finish. I like that. Thank you very much, AB.
My pleasure. Anytime, Mitch. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.